I am Sandeep Dahiya. I am a faculty member here. I'm Associate Professor of Finance. And it gives me great pleasure to welcome this very qualified panel. They'll be discussing the innovation, disruptive innovations. And the panel is going to be moderated by Guy Adami. We're delighted to have Guy, and I'm sure a lot of you know him. So we're looking forward to a feisty panel and a lot of fun. So thank you so much, and we are ready to take it off. Thank you, Guy.
Thank you.
Hi, how are you?
This is tight in here. I mean, we're all become best friends for the next hour.
Yep. Chummy, chummy.
So I'll just introduce myself real quick. Guy Adami. I'm Georgetown 86. Bob Gasser, 2 down from me, is one of my classmates. So this is sort of a coming home for us, which is really neat. What's even cooler is Bob's daughter, Olivia, is over to the right. She's a now sophomore here at Georgetown in the nursing school. So it all comes full circle, which is really pretty cool. So Guy Adami, Georgetown 86. It's funny, a lot of the NASDAQ folks are here. To the extent they ever watch our show, Fast Money at 5 o'clock, we do the show from the NASDAQ, so I see a lot of familiar faces, not least of which was Adina, who just did the last panel. We can get into the show and how we all started our careers a little later, but I want everybody to sort of introduce themselves first, so I'll go from left to right.
Hi, I'm Kashif Riaz with BlackRock. I've been with BlackRock about 5 years, and I am part of our trading and liquidity strategies group. And I focus in that context on the fixed income markets and particularly the corporate bond markets.
I'm going to shift our mics down. I'm Cynthia Main. I'm head of operations at PIMCO. I also sit on the buy side seat of the DTCC and all laws on the board of directors.
Frank Hathaway. I'm the chief economist at NASDAQ. Been with NASDAQ about 15 years. I run an internal research group focused on our market activities in the U.S. and in Europe.
Hi, I'm Cromwell Coulson, CEO of OTC Markets Group. We operate electronic markets for 10,000 non-exchange traded equities in the U.S. Our OTCQX market is a best market for companies that aren't penny stocks, which some of you may not think we don't have any, and we've got OTCQB, which is a venture market, which and then we've got an open market, our pink market. And we, I guess the best way to describe us is last year, 83 companies graduated from our markets to NASDAQ or NYSE. So we're the world's leading feeder market to exchanges.
I'm Bob Gasser, proud graduate of the Georgetown School of Foreign Service, 86. It's great to be back on campus, as always, with Rena and the team here. I started my career at JP Morgan, was there for close to 13 years, ended up running U.S. equity trading at the end of my stint there. I was on the Archipelago board. Probably the thing that brings me here today was the beginning of some of the disruptive innovation we've seen in the equity space that really has now played out very significantly and evolved. But from there, went to a smaller firm, NYFIX Inc., was the CEO of NYFIX up until 2006. When I joined ITG, I was at ITG for close to 9 years and recently left that firm.
So I'd like to start this with, we'll talk about the disruptions going on in terms of market and market structure and the innovation, but first I'd like to talk about sort of what's going on in the markets today. And I think, I see it almost on a daily basis, and I see sort of the public's fear of the markets given days that we saw in May 2010, and then most recently August 23rd and 24th, when you saw the S&P open down some 100 points. At one point, the Dow Jones was probably down close to 800-900 points. And I think the inherent fear people feel towards markets is amplified on days like that. So I want to start with Frank, and then maybe we can start a conversation. How could you, assuage some of the fears people might have, or how can you explain maybe some of the goings-on specific days like that and increase volatility on those days and what it means for investors and the public at whole?
All right, so there's, I think, 2 dimensions to that. There's a short-run dimension, what do you say, in the day or the week or the month that follows. And then there's a longer-run dimension, okay, how do you, and other people have talked about this earlier today, how do you learn from that event? What do you do and what do you try and address? So let me try and deal with both those. I think in the short run, the best thing you can do is show that you understood what happens, you have information about what happens, and essentially that there was somebody watching the market, aware of what was going on. And if you will, it's not a great line, but the market functioned as designed, if not necessarily as intended. And that was more of a statement about the flash crash than around August 24th, where the market really did, as other people have said, for the most part, work better, much better, than it had 5 years earlier. In the long run, what you do is try and say, all right, there's a problem. And the way it's been expressed today is no one wants to catch a falling knife, no one wants to get in front of a moving train. All right, fine. Somebody's identified a knife has fallen. Somebody has identified that a train is moving. Should we keep operating the market the same way, given that we know there's now a knife falling or a train coming at us? Or should we change how the market operates so that the change benefits the investor who may not have access or the ability to assess this information, as opposed to simply the change being identified to the market professional who is aware of what is about to happen and can take steps to potentially protect themselves. And that's sort of the longer term a way we have to go about both addressing what happened the other day and also, I think, expressing ourselves. And this is how we think about these issues and events.
So, Cynthia, a place like PIMCO, our show, we're sort of PT boats moving quickly or attempting to move quickly through, navigate the waters. But a PIMCO is sort of the aircraft carrier. You're not going to turn on a dime. And days like in May of 2010 and most recently, it's not going to change your views of the world necessarily. But were there any conversations in the halls of PIMCO on those specific days about, is the world changing? Our investment strategies, do we need to make a change, or is it sort of business as usual on those days?
Well, there's conversations every day about where the market is going, but as you're pointing out, we are long-term investors for the most part, and also we're generally fixed income. So most of our conversations have to do with what's the Fed going to do and that kind of thing, but our positions tend to be built long in advance. So there are lots of conversations that would occur, but as you're saying, it's maybe not as reactive. However, large firms are capable of turning on a dime. So, for example, in the crisis of 2008, I would credit PIMCO with being early to the game in terms of clearing swaps. We were the first to clear swaps in 2009 across all of our books of business. So there are instances where large firms do have innovation capabilities and where we will bring them to bear if necessary.
So this next question, it was get off the market real quick. My question is now to Bob. Bob has always been an innovator throughout his career, a career that started almost 30 years ago, and it's still strong today. Obviously, JP Morgan, ITG, but where do you see, what's the next area of innovation in terms of market structure, where your career is at, in terms of how the investing public is going to view and access the markets?
I thought you saw it this morning. I thought that the Larry Harris paper was, it's a great point of reference for folks to start to understand an opaque market structure. We spent a lot of time this morning talking about equities. Equities is pretty evolved at this stage of the game. When you think about other asset classes, that's really where I think the future lies. Now, the challenges you have of innovating in those asset classes are extraordinary. Within the fixed income space, obviously, there's not a best execution regime. There's not a regulatory framework as there exists in equities today. There's resistance from the dealer community who don't want to see the FIC world change to the degree it has in equities. There's even some resistance from the buy side. There's a tremendous amount of support from the buy side at the top of the pyramid, who I think view market structure as potentially constraining from a capacity standpoint. But as you go down that pyramid, there's a bit of a stultified view of the world. It's not broken. Why fix this? This is not. But when you see Larry's numbers, right? When you see empirical evidence to suggest that there's more that could be done, that's really important. And we were doing a lot of the same things that Larry is doing in terms of trying to build up a consolidated book, a reference price, And I think that going forward, you're going to probably see, I mean, I think we're all feeling it, and who knows what the Fed's going to do in the next couple of minutes. But we're all feeling that there's going to be a correction in the fixed income market. There's going to be a blowout in spreads. There's going to be a blowout in high yield. There's going to be distress. There's an ETF market now that's in full bloom in that space. What we've seen in equities is a nanobite, I think, of what you could potentially see in the fixed income ETF space, given a significant dislocation. So those markets, I think, and I was asked all the time, how long is it going to take? What's it, when is it all going to change? I think that if anything, it's probably going to be set back by a correction in the marketplace, and this will take years. This will take probably half of a generation to get it right. Although it was interesting to hear Mike Piawar this morning. It was interesting to see Larry Harris's piece. There's a building kind of momentum. There's building data. There's building empiricism to suggest that the fixed income market will change, but it will take a lot of time. Secondly, I'd say is FX. FX, folks, that grew up in the equity space like myself, look at the FX market as naive observers going in. This was probably me 3 or 4 years ago, and you say, oh, FX, it's deep, it's liquid, it's just a few pairs. I mean, around the world, it's got spot, it's got forwards, it's got non-deliverable forwards, it's got swaps and options. Oh, that's kind of interesting. We should be able to disrupt all this. No way. Not in the way that we did in equities. And the reason is the balance sheets are really the impediment. Everyone that trades FX needs credit. And to gain access in a democratic way to the FX market, you need credit. So that's limiting. You're basically limited to the universal banks. So the ability to innovate within FX is really, really difficult. If you think equities is complex in terms of market structure today, I mean, it pales in comparison to FX. But I do think, though, that for the folks who can figure that out on both ends of that ledger, FX and fixed income, particularly corporates, I think it could be another kind of industrial revolution for the capital markets. But it's not going to be without a lot of failures, a lot of, as I said, failed attempts. It's not going to be without probably some cathartic failures as well. So but those are the two places where I think there's going to be interesting opportunities.
And I'm going to touch on that in a second. I want to get to Cromwell here, though, quickly. Regulation, I think, is a huge driver in terms of what's going on in the world. We can't get around it. It's there, and it's there here to stay. But other than regulation, in your opinion, what are the other drivers that are causing changes in our industry, in the markets specifically?
Well, I mean, I think equities, we sell technology and data. And you usually are good at selling technology and data with increasing velocities and decreasing margins to the business. Equities were the perfect storm. Bonds, that's not happening yet. So that may start to happen. I mean, I'm on the FINRA Market Regulation Committee, and the discussions are there. And if you look at how regulation of bonds is right now, retail gets terrible best execution standards. It's years behind OTC equities. I mean, it is 20 years behind OTC equities, which is kind of incredible. But it's been an institutional first market. And I think you're going to see, if you start seeing retail taken care of in bonds, then you'll be able to sell technology and transparency to them. But a lot of the problem with the regulatory side is, once you become a regulated entity, you stop listening to your customers, reacting to what consumers and users are asking for more of, and you come down to Washington and say, hey, can you change this rule so people have to use my system? And that's a real, and you get a whole data side around justification of why off-exchange trading's bad, why dark pools should be banned, all of these things, why we should do these things and you go to your regulator, you go to your congressman, instead of sitting there saying, why are consumers using this? What's the value they're doing for it? Is this something that has some ickiness in it that we need more transparency with? Is this, do we need another rule, or do we need to give the information to the consumer so they can fix the problem themselves? I mean, I run a market and I get calls every day. You need a rule for this, you need a rule for that. Most of the time, if you wait a bit, it gets sorted out. Often, if you give people the data to avoid that problem, the new problem that pops up, like, don't sell an illiquid ETF on the open on a huge down day. You're going to get screwed. If you're a buyer, put in some low bids. You might find some good luck. I mean, that is, we spend too much time trying to make, say, fair markets mean no risk. Markets are about risk. Markets are about, we need to have our markets work the way we say they do, but we also need to have markets where users know they're dangerous if they don't know how to use them.
It's interesting. I want to go to Kashif now. In terms of transaction costs and the things that are going on in BlackRock, how you look at the world and new asset classes. I think it was interesting that Bob just talked specifically about foreign exchange. So I'm in this business about 30 years, and the moves we see now in currencies on a minute-to-minute, hour-to-hour basis used to take weeks, if not months. So clearly, and this is just my opinion, it seems as if the foreign exchange world is actually becoming an asset class on its own. So I'm sure at BlackRock you have those conversations. Can you address the things that you're looking at in this changing world internally at BlackRock? Are there new asset classes that you're examining and you're thinking about foraying into?
Sure. So I do think that we think a lot about liquidity and market structure and the impact it has on kind of the risk in portfolios. I think that's become increasingly important in recent years across asset classes, across our equity portfolios, across fixed income, across multi-asset portfolios. But we think about the impact of different fund types, different structures, and how they might have changed kind of, say, the historical volatility and historical behaviors of markets. So all of that feeds into the daily investment conversations we have. In terms of new asset classes per se, I think it's more about new vehicles. So, for example, over the past several years, I think passive investing obviously has seen great growth for certain investor types. And then more recently in the news with the recent volatility, there's been a lot of discussion about, for example, risk parity strategies. So different vehicles, I think, as ways of investing in the kind of traditional asset classes of equity, fixed income, FX, commodities, et cetera, are probably more the way I'd characterize it rather than new asset classes per se.
Understood. So Rena touched on this with Adina before, and I'm going to ask this to Cynthia. So you're responsible for all operations at PIMCO for all the asset classes. I think that's accurate, which is a pretty significant job, obviously. So what major changes are taking place in the post-trade world? How are buy-side firms like PIMCO revamping their OTC derivative infrastructures and processes? And that's something I think Rena was speaking to Adina. She actually said it's best for the next panel. So here we are, the next panel. So I ask you that question.
There's changes in all areas. So I guess I'll take the top four. The first one is the shorter settle cycle, and it does tag onto the blockchain conversation earlier. So in my career, I've been a chief technology officer and a chief risk officer. And as I was saying, I'm now on the board of directors of DTCC. So it does take 3 days to settle a stock in this country. There are many legacy reasons that go back to the late 1800s, early 1900s, why that is. And then also back to 1987. So the industry is working to make that happen sooner. We will be doing T+2 shortly. And in order for T+1 to happen, we need some sort of infrastructure transformation so that it becomes much more of an event-driven type of trade leads to the event of settlement as opposed to batches, overnight batches. And the other thing that's going to enable something like blockchain, which is real-time peer-to-peer exchange of securities, would be the requirement that investors fund their securities with cash up front. So right now, you have a little bit of credit. You can drop your check in, and then the check has to clear. And there's a whole generation that precedes us that still uses handwritten checks, and that's going to have to change. And it's a mental thing for the U.S. population that used to be afraid of banks. So that's one area in the cash equities and cash fixed income. Then in derivatives, lots of changes, mainly with cleared swaps. Still innovating with respect to cleared swaps. And there's an asset class that hasn't really been discussed, which is collateral. And one of the things that's inhibiting FX innovation is the need for credit, like you said, and the infrastructure required for collateral. So many people will call for collateral when exposed to the other counterparty. It takes 2 to 3, sometimes days and sometimes weeks for collateral to actually move. And back to Krista's point, that's because her conversation earlier, that's because there's a scarcity on some of those treasuries that are eligible collateral, and people can't come up with the collateral, and it inhibits all sorts of other types of settlement issues. So the big areas would be T+2, blockchain for settlement, and collateral innovation on the back of all this Dodd-Frank regulation that says, okay, let's move collateral today. You know, one interesting thing is the largest source of failed money movements today is actually daily margining. So there's an area where we had to innovate to do real-time cleared swap settlement, move margin every day. It actually, I would say, 16 to 20% of the time at other firms does not actually move. You won't get your margin every day. The dealers have to front that cash for a lot of the buy side, unfortunately.
Does that, just a question, Guy, sorry. Does that argue for taking more and more of the OTC derivatives market into an exchange-cleared environment? Or
remember, you got the exchange.
Some folks are resistant to that. Some are very open to it.
You have the exchange where they're standardized and they're listed, but then you have the settlement process, which is clearing, where you need that cushion. So the fact that you're moving daily margin between the cushion and the investors, that actual money movement, it sure could use blockchain technology one day, because the antiquated systems that we have today that move that cash, it doesn't really move. What's happening with those daily movements is more of a buffering, putting excess cash to make the international deadlines that are, Australia closed before us and that kind of thing. So just to try to limit the amount of movements that they have by putting a buffer of cash up there, but that leads to credit exposure, and maybe that should be collateralized. So it's kind of on and on.
Which leads me, again, Adina spoke to this. You just mentioned blockchain. I have Frank here, so I have to ask him. What's the role of NASDAQ's private market? You announced the blockchain technology space, to facilitate issuances. Can you speak? Adina gave a very thoughtful answer, but from sort of your spoke in the wheel, how do you view NASDAQ's role in blockchain now?
So, in addition to what Adina was talking about, I think a big part of our role is taking what is this innovative, efficiency-enhancing, integrity-enhancing technology and testing it, applying it in different places, and proving by doing that this will work, or discovering by doing that this is not necessarily a way to solve some of the issues that we were just hearing about. So we start with private market. You're replacing spreadsheets. Not a very high bar. There are other places in the world where the embedded infrastructure, so the inertia in instituting change is much less than it is in the United States. You have places in the world where all of us would have our own accounts at the settlement house and the clearing house. We would not go through brokers. We would not have nominee accounts. There are other economies that are, of course, quite small. We have 100 exchange clients around the world. We own and operate more than 20 ourselves. Some of these are not particularly large. And perhaps the next step for us, having seen what we will see with private market, is to go to one of these smaller markets and say, all right, we're going to run in parallel to what you use today, a blockchain clearing settlement system, gain some experience with how that would work. And that gives us a certain degree of ability to go to people like Cynthia's firms and others and say, okay, this is what we've seen in terms of efficiency. This is what we've seen in terms of changes and fails from this implementation. This is what we've seen with issues. We're going to learn. We're going to find that things aren't perfect. And because of sort of who we are and where we sit, as we thought about blockchain and our investments in blockchain, both in money and time, said, we've got some opportunities here to do things that are actually fairly unique because of who we are and different places we operate.
This wasn't supposed to be on the test, but since we're at Georgetown, and a lot of smart people here, and I'm not looking to put anybody on the spot, but it's just announced that the Fed is leaving rates unchanged, and I'm sure things are moving on the back of that. So since it just happened, and since they have become one of the hugest drivers in our markets, I'm just going to ask the folks what their views are in terms of this announcement, understanding you probably haven't read anything about it, but just the knee jerk that rates are remaining unchanged. Kashif, what is that sort of, you hear that, what does that say to you?
Well, I think that coming into it, it was kind of a toss-up, right? So it's not a particular surprise to the markets for that to happen. And even if the decision was different, if they were to raise slightly, I think the broad market expectation was for it to be a very slow path. So while the date of the first move obviously isn't today, maybe it's a month or 3 months or even a little further from now, I don't think it changes the broad market picture all that much.
Understood. Cromwell, when you hear that, does it say anything to you about the state of our economy or the state of the global economy? Is this the Fed blinking, or am I looking into this too deeply?
I mean, blinking is a big word, freezing, and not a terrible thing for Washington, but I mean, it's basically, you have market times. Every time we have like a market that gets volatile, it either gets worse or people get, less scared. It's not as bad. And that's, it's like, so we're either going to have something where we're having a worse time going and there's buying opportunities and you should kind of fade in, or otherwise you're, bad times are coming and you're going to have a little less money for vacations. I mean, but it's like America's still fine. So that's my answer. I'm not going to trade. We look at, what's interesting about the brokerage industry is now you just look at transaction accounts, and a bit of some Fed activity and some shocking the market is going to create volatility and profitability and take the VIX up. And we don't really want to talk about this in the industry but markets moving, people either really wanting to buy or really wanting to sell is kind of good for our industry, because for the most part we all sell liquidity, we find liquidity. And kind of hanging out like this, when the Fed's going to do it, people sit on their hands, so it's not a great thing.
Understood. Cynthia, PIMCO obviously, again, I said it's the aircraft carrier, absolutely is. I know you had conversations about this internally, and I'm sure a lot of people say quarter point, not a big deal, but, in terms of PIMCO's view and the bond market, where do you see rates headed? 10-year rates, if I'm guessing today, they're probably around 2.25%. Do we come back here a year from now south of 2% or north of 3%? In your opinion?
God, you're so funny. I just process the trades. Tens of thousands of trades a day. All the monies and securities change hands. Zero fails.
No, I understand.
So,
I'm just curious, but I know that when you reside in a firm like that, you hear ideas.
You're wrong.
Become. I'm wrong?
Yeah, I mean,
she'd be day trading her account like a genius and retired. You're totally wrong.
If I knew where rates were going, I would maybe make those decisions.
Understood.
Instead of
I didn't mean to put you on the spot. I figured I'd here.
I don't know. Yeah. Trade up, trade down. All the trades must settle every day by 3 p.m.
Understood.
I've got an advantage over you in the questions from people like Guy are about the stock market. Like, I'm a regulator. We can't pick directions.
No, I understand. It's just such an interesting day that we all find ourselves here at this time of the day, and I was just curious if you had any views. So I'll leave the bond market question off for now, and I'll go over to my friend Bob Gasser. Exchange-traded model. Does it work for the bond market? Does it work for derivatives? Do you see it headed in that direction?
I think we just speaking to derivatives, I think it works well for derivatives that have some degree of homogeneity, like interest rate swaps, et cetera. And obviously that market has been changed as well by Dodd-Frank. But I think futures, certainly equities, options, I think all of those markets work very, very well. I think what you don't want to do is limit creativity amongst both the buy side and the sell side in terms of their ability. And there's a lot of smart people at PIMCO and BlackRock. They have a tremendous amount of scale. They have a tremendous amount of human capital and talent. You don't want to waste that in terms of their ability to pursue alpha on behalf of their clients. And so I think there's a limit to which you want to force every OTC derivative contract onto an exchange. There are other mechanisms, interestingly enough, that have grown up around the derivative market to give the regulators, I think, some comfort that they have some degree of knowledge or control over the marketplace, that there's an audit trail, that people understand the exposures. Nobody wants to repeat 2008 and AIG and all the other things that happen there. And I think that we're in that place right now where there seems to be the right balance, but there's still a lot of Dodd-Frank rulemaking to come. And that's a little bit, I think, for the derivatives market, a little bit concerning as to how many more securities will be forced into an exchange-like or a CEF-like environment. But there's a lot of RFQ stuff, a lot of RFQ tools out there, whether it's Bloomberg or it's Market Access or it's a firm that we acquired during the later stages of my time at ITG, that give both the dealer and the buy side, the asset manager, the ability to put process and controls around that, and also give the regulator the ability to come in and look at the whole food chain, the whole workflow. So I think there again there is innovation going on in that space, but I don't think we should over-regulate. As I said, the more creative parts, and by creative I don't mean pejoratively creative, I mean the more interesting parts of the derivative space that I think are still very, very important to the asset management community.
Can I just make a follow-on to that, unless you were...
Yeah, no, you can.
So in terms of listing things on exchanges and to Larry's presentation, helping the retail investor, keep in mind that in the credit default space, where there's quite a lot of liquidity, really only the first 50 names trade on a daily basis with any kind of volume. And when we started clearing all of these swaps, these credit default swaps on corporates, really there were 80,000 symbols. So it's really a lot of screen real estate to try to, go through and find out what's for sale and what's listed and gather liquidity. So where I see the innovation just from the outside, watching this technology emerge, is really everyone to everyone price streaming. I don't want to say cross trading, but buy side to buy side or retail to sell side. Really, when a retail investor is trying to buy $5,000 worth of bonds, it takes a lot of human intervention to go get such a small piece. And it takes people on phones trying to find out where is that exact bond that retail investor wants when that retail investor might see a price on Trace. Okay, for the normal, let's say, U.S. citizen trying to buy a $5,000 bond. So where I see technology emerging, and it's not quite there yet, is more in a price streaming capability or swarms, where like Dutch auctions, where you would get together and, okay, this is now the short duration consumer cyclicals auction type thing. It's harder for large investors because, again, the desire might be to buy larger pieces, and it's hard to aggregate that kind of size equivalently across a larger book of business. So the dealers do become important, but they have some balance sheet limitations right now, and many of them are just flow dealers. So I think there is technology emerging to solve some of those problems, but I'm not sure the exchange is really the solution there. There might be some other things coming about.
And that's, I mean, we had on the earlier panel, we had everyone agree with Andy panel. And, and he said all off-exchange trading in equity should be banned with the exception of the large blocks we do. And, and it's actually, that's been the discussion for the past 15 years. Is how do you move trading to an exchange matching engine to solve the problems of this messiness outside? How do you centralize, which, regulators like centralizing control of things. The messiness of a network is, no regulator would have started Facebook, is because of, what someone could have posted. But what happens is, and I find it interesting, is in small cap companies, we have an interesting dynamic. 90% of small cap investors for a $50 million NASDAQ company are individual self-directed investors coming through the electronic brokers, the E-Trades, the TD Ameritrades. Their order flow of market orders goes completely to wholesalers off exchange. That's the market choosing. Same thing happens in England of retail order flow. But we're having this whole discussion, how do we make exchange matching engines work for companies that don't have order books? Instead of saying, okay, there's a dealer market, how do we improve the dealer market? Some of the same things we do for matching engines don't work for dealer markets. And how do we have them compete and let the users choose what's better? I mean, for us, we run, basically a broker network for trading that lets people do bilateral connections. directly connect. It's kind of what networks do. It's what NASDAQ was 25 years ago with better technology and transparency. And I look at my innovation challenge on the trading side is how can I let market makers build clout on undisplayed supplemental liquidity? If you've got a market maker who's your competitor and you've got one side of the trade, how will you know historically that that firm, over their quoted size, will 20% of the time or 50% of the time provide 500 or 10,000 more shares? And how can someone build clout over time? Because if you look at the academic data about matching engines, when they have hidden liquidity, it all gets sucked out. It disappears very quickly. Bill Hartz wrote a paper on it, so if you have problems with that idea, blame him. But second is dealers are different. They can add supplemental liquidity every day as long as it adds profit as it works for them. And when you're a dealer, actually, when you became the axe in a stock, remember Hambrecht and Quist, they do 50% of the volume in their IPOs, or the trader got the stock taken away. You build profitability, you suck in more liquidity. So I look at the challenges is, we have to stop saying an exchange matching engine is the fix for securities that don't have deep limit order books. And we have to have different markets that we support based on user choices. And in small companies, that's the ludicrousy of the tick study. It's all about banning off exchange trading, moving it more to a set. It said, how do we have more liquidity, a better execution response for what's primarily retail investors? Nobody wants to say that in small company stocks because that's risky. They're buying these things self-directed. But how do we improve that experience? And that experience is not being satisfied by exchange matching engines.
Yeah, I think another way to address Guy's question is when you're talking about the exchange model, there's not one exchange model. There's the matching engine, which might be fine for on-the-run treasuries, liquid equities, and then there are exchange models that are also dealer models. And we run
no, actually, it's not. Because when NASDAQ became a stock exchange, you were forced to set priorities.
Well, you're talking about the U.S.
That was the big rope-a-dope. It got pulled in. It's like you have to become a matching engine. You lost your broker network opportunity. Opened a door for me, so I can't complain. But it is, that's the part of exchanges are centralized, is the exchange model is centralization. And in most other businesses, middle-tier intermediaries are being removed by bilateral connections by producers and consumers. And the fact is somehow in equities markets, because consumers of liquidity for individual investors are going directly to producers of execution and liquidity, it's somehow icky because they're not going through the exchange. The same way bottles of wine don't go through the unionized New York liquor distributors, that they're coming through FedEx. We need to support more bilateral direct connections and more diverse business models and let consumers choose where they're going to get their liquidity.
Yeah, I don't think we're disagreeing. You're just focusing on the U.S.
Yeah.
And I'm not. But yeah.
So I'll change gears here. So Kashif, this is for you. Very specific question. You and your team have put forth an intriguing idea addressing illiquidity in the huge investment-grade U.S. bond market. Many bonds have turned into pieces, nice to look at, but tough to take home. I think that's one of your quotes. You've expressed concern about this fragmented market that are now dominated by new issues, but has very little secondary market activity. So I ask, why has the liquidity disappeared, in your opinion?
Sure, there's a number of reasons for it. I think, if you look at the structure of the bond market, it's extremely fragmented, heterogeneous. There's the underlying assets. There's a lot of different line items that are not fungible securities. And there's kind of underlying from the issuers good corporate finance reasons for that. But there's a lot of different securities. And the traditional way of tackling that was for the bond market to be an over-the-counter kind of principal dealer intermediated market, in sharp contrast to kind of the exchange structure of equities. Over the last several years, both the dealer capital and the leverage that used to be in the system has, generally for good financial soundness reasons, gone down. And our work and kind of observation on this topic revolves around, given how much bigger the global fixed income and specifically the global credit markets have become in an environment where kind of the intermediating capacity through the OTC market is at best static, but probably smaller. What are kind of really not just one idea, but a constellation of ideas that can kind of help improve liquidity and make the market kind of well suited to the size it's grown to. And so we have a number of ideas that all dovetail together, and I don't think we're unique in the industry. And I think there's a very rich dialogue underway in the industry over the past couple of years on this topic. But some of those ideas involve, things that Cynthia mentioned earlier about alternatives to traditional bond trading and alternatives to traditional equity trading. And there's trading protocols and mechanisms that are somewhere in the middle, whether it is kind of crossing networks, whether it is all-to-all networks. We think that there's a great deal of entrepreneurial activity underway right now in that space, and as we see those initiatives mature over in the recent past, it feels like in the next few years there will be pretty material developments and evolution to move some credit trading activity onto electronic forums that are actually step changes from the status quo. I think so far electronic trading in credit has gotten pretty good penetration. It's grown a lot in recent years. It's probably something like almost 20% of the market right now. But in general, so far it's been a process improvement where the same practices and protocols that were done on voice trading have been moved to a more efficient electronic platform. But what we haven't seen yet is actual kind of process enhancements and protocol changes that uncover heretofore latent liquidity. And we think that's the next wave of things, and we're very supportive of moves in that direction. So that's kind of one set of ideas. Another set of ideas that we've thought about is actually thinking of ways of actually at the largest and most liquid end of the credit market, so say larger cap investment grade companies, looking at those issuers and having a lot of dialogue with them about whether they can kind of produce the assets in a way that's a bit more homogeneous, that's a bit more amenable to two-way exchange type trading.
So let me ask a follow-up quickly.
Yeah.
So do you factor in liquidity or lack of liquidity in terms of investment ideas? I'm sure the answer is yes, but does that play a bigger role today?
Yeah, so the answer is definitely yes. And I think the other thing that's important to note is that liquidity risk has, frankly, always been an important part of evaluating investment risk, and but it is in a market where kind of secondary market depth is more challenged and potentially less predictable. It is an increasingly important part of thinking about how to construct a client's portfolio. Yeah.
So I'll ask this to Cynthia then. In terms of transaction costs, how is the world changing for the client in terms of transaction costs, best executions, those type of things? You mentioned 80,000 symbols before. Obviously, there's costs associated with, but how do you see that world changing?
Well, in the cash equity space, the transaction cost has decreased as a result of automation. So everything from digitized settlement instructions to electronic matching straight through to settlement at the Central Securities Depository, that's all become almost hands-off, SWIFT messages or what have you. But on the other hand, there are heavier transaction costs in the derivative space with cleared trading requiring lots of innovation and the increased use of collateral. So many people used to silo collateral. It'd be collateral for futures, collateral for FX, or collateral for derivatives. But now firms are sort of collecting their collateral teams all together, and that's increased the cost of trading. So even things that are settling in 3 days sometimes require collateral because you may not trust the credit worthiness of the other counterparty. So maybe there's some initial margin put up front in order to continue a trading relationship after that. And that kind of parallel infrastructure ends up increasing the cost of securities processing that otherwise might be fairly cheap.
So this is not a Cromwell. There's a lot of money sloshing around the system, clearly. And obviously today, nothing's really changed. So I'll ask you this. Has it become easier or more difficult for companies to raise capital?
So, I mean, for small companies, I see it becoming easier. I mean, the process, though, is really what's changing with the Jobs Act, which is kind of incredible. It was, a long time ago when it was passed, and the rules haven't changed. And for small companies, there's the private placement market, which is pre-Jobs Act. There was no transparency about what was happening. And now we've got general solicitation under Reg D. We've got Reg A coming, which is approved, and we're seeing, which is a great tool for smaller companies. We're hopefully going to have crowdfunding. My expectation is in 10 years, the investment banks for small companies are going to be displaced by the crowdfunding portals, the online portals. The same way you want to trade through E-Trade, you want to raise capital, invest in something interesting, and you're going to be doing it through a crowdfunding portal. We don't have a system of regulation that works in the United States because we have all these different state securities laws, which is still ludicrous. Spoke a little bit about an intrastate offering. There are very few, maybe a community bank. Trading is all interstate offering, all interstate trading. There's no electronic trading that takes place that doesn't go across state borders. So Congress and the SEC needs to step in and take the states away from that role. And they're doing it gently in many of the Jobs Act crowdfunding things. But what we're seeing, I mean, we had our first our Jobs Act IPO was a Bitcoin fund. And it was pretty impressive because it was raised by Second Markets. And Second Markets is a competitor of NASDAQ Private Market, but they raised with a general solicitation Reg D private placement, and after 1 year, had it trade on our OTCQX market. And they have secondary liquidity. Even more exciting, an ETF just bought a big stake in their Bitcoin fund because they could now value it publicly. So we're seeing those things assembled, but for the most part Apple went public on NASDAQ in 1980. The states didn't even trust NASDAQ market then. You couldn't get blue sky, but Apple still did $1 billion IPO, and it was almost $2 billion by the end of the day. But it started to work. And we're seeing the same things for smaller companies that the Jobs Act addresses. We've had 4 community banks go public of privately issued shares onto our top market. And they're building a secondary market. So I'm seeing what we've done in the trading space is going to move to the capital raising space as long as regulation catches up. And that's hugely exciting because the investor has an incredible experience in our public markets. In capital raising, because of restrictions, because of state regulations, it's been awful. It's been terrible for the investor, the smaller investor who actually invests in small companies. PIMCO can't invest in a $50 million company very easily. It's just not going to, that's not going to work. But that is changing. And we're going to be here 5 years talking about, wow, some people are becoming successes in funding portals. And in 10 years, that's going to be the world. And that, so I'm very optimistic that it's changing. Some of the old legacy ways aren't great for small companies. There's still pipes that have toxic resettable preferreds that aren't good for small companies. There's still banks that are more interested in the capital provider than they are in the funding the pipe than the company's long-term health, and NASDAQ has that on their lower tiers. There's still lots of regulatory complexity that small companies see. Community banks, we have hundreds on our markets. They're just getting killed with all this regulatory complexity, and they're not a risk to the system. They're an asset to their community. So I mean that's my my side is I'm very bullish on capital raising. We're seeing more interesting pieces, but it's not figured out yet. The regulation hasn't been gotten. We need to get it. So for capital raising, it's a national market. The state regulations are pushed out of it, and also that the information is on investors' screens, not hidden in dark rooms.
So then it naturally then comes to you, Frank. So you mentioned regulation. So how is regulation impacting the markets? Dodd-Frank, the European market infrastructure regulation. Your job has gotten very interesting very quickly over the last couple of years.
Yeah, it's been kind of a series of full employment acts, and I'm not going to live long enough to see them all done. So significant impact. Some of it has created competition and challenges to NASDAQ. Other aspects of it, in a sense, inhibit competition because regulation becomes a barrier to entry.
Yeah, I mean, I don't think nobody can do what I did today in the regulatory environment of take what was a phone book electronic, and the SEC was incredible. They didn't make us register as an ATS at the time. They didn't. They said, go to it. You're going to get brokers to post prices. You're going to get brokers to trade electronically with each other. We're going to do Reg Light. Now our trading systems is a super ATS, under Reg SCI. Will probably be made a Reg SCI critical system, even though they said under SCI no ATSs are there. But that's that regulation we grew into. I actually think in equities, the arms race the arms race is done. It's like now it's a Cold War. I don't see a ton of new innovation that's going to come in, and it kind of protects you because the existing players, they may acquire a few. They may, if you acquire someone who does a service and they go away, they get replaced. But regulation has now created such a barrier in equities. The OTC markets group, how we started out, isn't going to come into the business. And I think that's, in some ways, a sad part of the regulatory side instead of having something we can scale into.
Yeah, it varies by jurisdiction. Just let me give you a quick example on innovation and regulation. Flash crash, May 2010. It was an American event, happened at the end, after European market hours were essentially over. By the end of the summer, we had limit up, limit down in place in our Nordic markets, 3 or 4 months. It took about 2 years to do that in the U.S. And that's not a knock on the regulator. It is just a very different process.
And that's the part, there's been a whole bunch of discussion about venture exchanges. And it's actually interesting, the panel, instead of having a discussion, how do we make, NASDAQ has their capital market, and NYSE has NYSE MKT, which are essentially what you would partially a venture exchange. It in some ways, if you look at the top tier of the AIM, and also there's our market. We had 83 graduates. TSX Venture had 22 to their AIM had 5 last year. So I think we perform a good role. But they didn't have a discussion. What are the things we need to do for smaller companies to improve NASDAQ's lowest market or the OTC markets? It was all we need this new creation. And it was kind of led by not understanding what it costs to run an exchange. Direct Edge didn't even have a listing business, and they had 25 people in legal and compliance, and it was growing. And the ability to do rule filings, the speed of change, the whole process of the innovation. I mean, the NASDAQ private market is innovating hugely. Second Markets has innovated hugely in having companies that aren't served well by exchanges. We've done, I think, some okay things. But those parts have taken place within the ATS regulation, within the ability to innovate. And I don't think there's an understanding how heavy, and there's a reason for it, because exchanges are where the index securities, the securities that are in the investable indexes are. That's our nation's wealth. We need to be really slow there. We need to have a really high level of governance. We need a really heavy thing. But smaller companies, we don't need that. And we probably want to have a system which is have venture markets, and in fact the AIM market or NASDAQ's First North, they're not even exchanges. They're MTS, Europe's version of ATSs. We want to have something that fosters innovation, lightweight regulation, but have it for the markets where there's an incentive. Once a company gets to a certain size, they go to a major exchange.
So I'll go to Bob then for this, because it dovetails into this question. So what's the right balance, in your opinion, between transparency and liquidity, I guess?
Well, I just want to just finish one of the points that was just made, and that is that the other thing, and Adina alluded to it in her comments earlier. The other thing that I think is increasingly an impediment to small cap issuance is Starbucks and a lot of other things have been in the frame for a while, but activism is an asset class. Make no mistake about it, is now an asset class, and it goes across the spectrum from Apple down to Rena's on the board of a small cap company. It goes from the top down to the bottom in terms of capitalization. If you're a founder and you're thinking about monetizing some portion of the equity of your firm and potentially putting it at risk, that's a pretty stark environment to be operating in. And so I wouldn't underestimate activism and its kind of chilling effects on the notion of capital formation. I've survived 2 activists. I can tell you, it is a brutal, nasty, expensive, drawn out, distracting fight. It takes you out of the business, period. And if you're a small firm, it definitely takes you out of the business. And you have ambulance chasers who are in the business of advising you, whose tab rises daily, and you can easily end up with a multiple 7-figure tab and have a $200 million market cap. That's devastating to a company that has to deal. Now, I'm not saying that activists are all bad, and I'm not saying they're all. I'm not going in that camp that says that all companies are perfect, and that's not what I'm saying. I'm saying that there is a proliferation of activism, I think, that is sometimes fair and sometimes very unfair.
But there's also, in the VC and the private equity space, they turn over their management teams and kind of sell out, much more actively than Dan Loeb does of his portfolio. So we spend this whole time, and it's like saying, oh, the public markets, if you don't run well, you run into trouble. If you don't run your business for shareholders, and we need public companies to run businesses for shareholder value, and there's some questions about cost and how the process goes. But it's like we kind of shoot ourselves in the foot in public equity markets, because actually, if you are public, you've got perpetual capital. If you go to Carlyle, it's 3 to 5 years they're selling you, and then they're selling you again. And if you don't perform in those sprints, you're gone. Your management team's gone. And and public markets do some great things. They provide capital for growth. There's not private equity side of businesses it's much more like how can we extract maximum capital out of those? How can we put the financial engineering? So I think we should sell in. There's a lot of value as a management team to have perpetual capital being public if you perform. The most sustainable companies are public companies, and it's great to be a company if you're performing well, your stock price is liked, and you're taking good care of shareholders.
Yeah, I'm going to tell you that's actually a great perspective on it. I will tell you from a practical perspective that I was on the receiving end of 2 activist campaigns, very sophisticated investors. And the campaigns were almost identical. You guys have too much capital on your balance sheet, too much capital, and it's sitting there, and it's stultified, and it needs to be released to us right now. And they weren't over the wall. In other words, they didn't see the clearing demands of our business every day. And the more we tried to explain it, the less patient they became, because that's not what they wanted to hear, right? They had an investment thesis, and now they were trying to confirm it, as opposed to the other way around. And that happened in both instances. And so, yes, I do agree that the private equity market is very different, and it can result in the same issue in terms of managements and performance and all those good things. But I wouldn't jump to the conclusion that activism is dealing with efficient information. And sometimes it doesn't matter. It just doesn't matter.
There's bad practice in everything, but also it's like kind of, ITG, your stock went from 40 to 15. So I'm not, you want to be straightforward about activism is they're going to be there if they don't see the stock performing. And that's
They were there when the stock was performing. So and there were these massive distracting debates about the capital that we had in our balance sheet that quite frankly they were regulatory. There was a regulatory directive. It was all about the capital we needed to clear our business globally. Period. It wasn't. We weren't hoarding capital, et cetera. Except I don't want to go off the reservation here. But
I think activism is something that it's the agency principle conflict. And there's actually something where you can look at the large exchange that we've done listing standards, which hurts small companies in that on major exchanges you need to have fully independent boards. If you're a large shareholder, you become a secondary type of director. So where we used to see a VC took their company public, and stayed on the board for a long time. We now see a trend where they're leaving because they become these second-tier directors. And And that actually matters if a company's primarily owned by index funds. You're in the major indexes because it is. But for smaller companies, actually you want to be a tag-along with a big investor who's dedicated in a company. And we kind of want to make our smaller company markets work so private equity can take their companies public till they want to sell it all, till they're on the way out the door. So they take it public as part of the process, and we get them back in earlier into the market. And I think we've kind of shot ourselves in the foot by not having the ability for large investors to be as part of the governance process in public companies on exchanges.
The Nelson Peltz Carl Icahn panel starts at 5. I encourage you folks to stick around. So in the final few minutes we have, I'll open it up to questions from the audience, to the extent anybody has any. Gentleman far right, if you guys have a microphone. My right, I apologize.
Thanks. So my question is to Kashif on the BlackRock side. BlackRock has put out a number of thought pieces and white papers, and you alluded to some of them regarding a call for issuers to change the way they issue capital. So the bonds are easier for you and your firm to trade in the secondary market. Why is there not an ETF on Ford or on GM? So there's CDS on Ford. You've collapsed everything into something. Clearly, the companies want to issue exactly what they want to issue when they want to issue. So why hasn't there been a disruptive innovation using iShares platforms or something?
Yeah, no, so that's it's a really interesting question, and I think this, I'd say the debate on, or the market discussion on liquidity and market structure in the corporate bond market feels like it's it's been in high gear for about 2 years now, and the idea you mentioned of, say, using the ETF technology to create more specialized products, such as a single issuer or a sector ETF, is one that has come about from a few industry participants and been written about in just the past 6 months. So it hasn't happened yet, but it's on the menu of things that are being actively bandied about. So I would, in terms of kind of new product development and product innovation as one of the routes to helping to mitigate the challenges the market finds, I think that's one very feasible one that you might see development in the next over time.
Just a question on that, though. In order to have an ETF, you have to have a deliverable basket of securities. So if it's tough to obtain the securities needed for a buyer of the ETF, and equally tough to sell the securities when somebody is putting through a withdrawal, isn't that currently one of the constraints?
Yeah, I mean, obviously the way ETF technology works is, generally they're replicating an underlying index, and there is, every day a basket that the third-party authorized participants can use to create or redeem shares. So when the flow is, focused in a very one-way direction, there is a risk to the ETF that its liquidity deteriorates to the level of the underlying. But at the same time, the ETF technology does create a kind of secondary market in the ETF shares as well, which we think is additive.
Questions? No? Well, Rena, then I'm going to let you take over. I want to thank everybody for being here. Thank you for your time. Thanks for having us here at Georgetown University, folks. Thank you.
Well, I just want to thank all of you for being here today. We've had a fascinating discussion. Some solutions have come up. Some innovative ideas have come up. I think of the exchange business. If I think of what's been going on in the last 10, 15 years, there's been so much innovation, there's so much disruption, and we in higher ed are going through that. And I tend to think in the next 10 years, I'm a finance person, I'm a markets person, so I'm always comparing it to the exchanges. There was this innovation that was led by technology and global competition in exchanges. And the same thing is happening in higher ed. Technology, innovation, the cost of higher education, all of those issues we are addressing right now. So the 10 years for us will be very similar to what has happened to market structure in sort of the last 10, 15 years. So thank you for being here. I do want to thank a couple of people. First of all, we couldn't have done this without our finance faculty, who play a very important role here at McDonough. And really the person who is responsible for putting all of this together and deserves a big applause is Jessica Divest. Jessica is the assistant director. And then the whole McDonough team comes together, our marketing and communications folks. They, we take care of the content at the center, and then they take care of all of the logistics. So it's a teamwork between the faculty and the staff at McDonough, and it works out very well. We hope to see you next year, and as I mentioned, we have a congressional briefing tomorrow on housing finance. This is closed doors that we do with our friends, Stacy and the Milken Institute. And then in October, we have an event in New York, investing in global innovation, the role of alternative investments, and that should be a pretty fascinating discussion also. So again, thank you. We have a reception after this, and look forward to seeing you next year. Thank you very much. Yeah.